Hello and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com. That's Kaizen Kaizen. And while at my website, click on the radio page to check out past shows and subscribe to our program on Apple Podcasts, Spotify, YouTube Music, or Amazon Music. All right. For an ever-growing segment of Americans, a 401k is one of the most significant elements of the retirement strategy. And if they work for a company that offers, let's say, a 401k match, well, it becomes even more essential. So that begs the question, what should I do if my employer eliminates its 401k match? Well, a U.S. News and World Report article called What to Do If Your 401k's Match is Cut, it tells us that when economic times begin to get, let's say, a little bumpy, well, some companies will cut their 401k match and then in an effort to reduce overall expenses. So if you find yourself in that position, well, your first step should be a review session with your financial services professional. Now, thankfully, the article does explain that if your company shrinks or entirely ends its contributions to your 401k, there are some things you and your financial services professional may be able to do to keep you moving forward toward the retirement, well, you aspire to. But before we get further into today's show, let me introduce my co-host, Tony Shore, who I know will never eliminate his contributions to the show. Hey, Tony, how are you doing, buddy?
Yeah, number one, Albert, I'm never going to eliminate my contributions to the show. And number two, I'm never going to stop contributing to my 401k or
There
IRA.
you go.
As long as my company has a match to my 401k,
Yes.
I'm going to put in at least enough in there to get the full match. Now, if they aren't going to match, I'm going to knock on your door and say, Albert, I'm going to need to put this amount of money each month into a personal IRA or maybe a Roth, right?
Right.
Yeah. But you have to have a 401k strategy. And 401ks, most of the people I know have 401ks. Very few people. I mean, certain government workers might have what is it called?
TSP. Yep.
A
Tax
TSP
savings program. Yep.
Maybe they have a TSP, or some people don't contribute to a 401k and just have IRAs. But the majority of people, I think our listeners out there included, probably have 401ks of some type if they're still working.
Yes.
Most companies now offer a 401k. I think every company I've ever known that has more than just a handful of employees at least offers a 401k. So a lot of people have those, and I'm glad we're talking about this today. Yeah. Where do you want to begin with this topic?
Well, the article. Let's go back to that article there with. What do you call it? The U.S. News and World Report.
Yep.
It actually it says if you suddenly lose, let's say, your 401k match, well, you should assess your overall financial picture. Sure. Situations like these can actually sometimes produce panic to people, and it can sometimes produce poor decision making. Now, a financial assessment may help you elevate, or I should alleviate, the potential panic that happens when, sudden changes like that for your future planning occurs. Also, you should reach out to your financial service professional to set up a meeting, and also bear in mind that a healthy 401k is about more than the match, like you had mentioned, Tony. Right. The article explains numerous retirement accounts provide you with possible tax advantages, but when it comes specifically to 401ks, your plan may shelter gains, interest, and dividends you earn while money is invested in your account.
Right. And I think that's a great reminder that, hey, if we get unexpected financial news that could upend our financial strategies, we shouldn't jump to conclusions. Instead, we should get together with somebody like yourself and make sure we have all our ducks in a row and understand what's going on and have a strategy in place, right?
Yes, yes. And as with many other parts of our lives, it's not a bad idea to get let's say, a second opinion before we make a financial decision. Now, I take pride myself in providing clients with clear, calm, and data-driven insights. So if your 401k match is suddenly gone, well, your next step should be to prioritize key expenses like, let's say, your mortgage or your rent, utilities, food, and transportation. And then make sure that you're positioned to continually, I guess, addressing those essentials. Now, after you reviewed your budget, there's a good chance that you'll realize, well, you can keep saving for your retirement. And then finally, it's important, well, to not stop making contributions to your retirement savings overall. If you do so, you may end up playing retirement catch up later on, we say, and that's not a position you always want to be as you're looking forward to those golden years, Tony.
Yeah. Well, and as we've talked about on previous shows, Albert, nearly all of us have retirement goals. We have some type of goal or idea for retirement. Maybe it's to travel or pursue our hobbies, adventures with the grandkids, volunteer, whatever it is. It's important that we don't put our goals at risk by stopping our contributions to our retirement accounts, right? Even if it's just for a few months, that can be devastating. You want to be regularly contributing
Yeah,
because most of those accounts obviously tied to the market, and you're regularly buying in when it's down or on the way
yeah,
down or up.
for
So
sure.
that's really good. That's dollar cost averaging into the market,
Correct.
and
Correct.
that's very beneficial combined with, as you've said, compounding interest, right?
Yeah, and add time. You
Yeah,
give yourself time, dollar cost averaging, and compound interest. Guess what? You
yeah,
will have a recipe for success in saving
yes,
for the future. That's what's big about that. And then also, when it comes to your contributions, you have to remember, if you can kick in more money, well, that's likely a good move. But like I said before, make sure you review your budget. Make sure you review what your tax liabilities are currently, and then can you afford to put in more, or does it make sense to put it elsewhere? Now, it's possible that you may discover that you have, let's say, enough money remaining to cover, let's say, the amount your company was contributing to your 401k. So furthermore, if you lost your company match, well, using your own money to replace it, it may be a way to make lemonade out of lemons, let's say here, Tony. And
yeah,
how? Well, because doing so may eventually lead to higher returns later on, because purchasing stocks right now at current prices is better than pausing your contributions overall and then picking them back up later when prices are likely probably going to be, guess what, higher later overall.
yeah. Higher later.
Mhm.
So what about IRAs?
Yeah. Well, the article also states about RAs that it may provide more flexibility when it comes to investment options, Tony. And that's
Right.
the big difference between your own personal IRA and a 401k outside of the matching contributions. Now, for example, in 2024, the contribution limit to a 401k is $23,000. And if you're 50 and older, Tony, you get to do what's called the catch up, and that brings that up to $30,500 in total. Now, for an IRA, you may contribute to a maximum of $7,000 if you're under 50. And then if you're 50 and over, you can contribute $8,000. Now, as many of you listening today likely know, there are two main types of IRAs, though. A traditional IRA is like, let's say, a 401k, because the money you contribute to your account lowers your taxable income. Therefore, you'll pay taxes once you begin taking withdrawals. Now, on the flip side, with a Roth IRA, you pay taxes on your contributions right away. And that means when you begin taking withdrawals, they'll be tax-free for you.
Yeah, yeah, and that's, hey, I like the sound of tax free, right?
All of us does.
Yeah, yeah. But you've mentioned before everybody's situation is different, so maybe an IRA isn't a good fit for somebody.
You're exactly right, Tony. In fact, like many of the financial tools and options, that are at your disposals, IRAs come with positives and negatives. Now, that may make them a good option for one person and maybe an entirely wrong option for another person. So if you're thinking about an IRA, I urge you to begin the process with a conversation with your financial service professional before making a final decision.
Yeah. Yeah, I think you have to work with somebody like yourself.
Mhm.
But in fact, speaking of that, why don't we take this time to let our listeners know how they can get a hold of you if they want to set up that complimentary, no charge, no obligation
Yeah.
consultation with you?
Folks, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen. Or you can call my office at 586-752-7008 and discuss how we can answer your questions, address your concerns about your 401k, maybe your retirement path, or any other parts of your financial strategy.
All right. Well, this has been a great discussion. I mean, you've been looking at some of the things that we should do if our company ends a 401k match. What do you
Mhm.
have for us next?
Well, let's keep going on with our discussion about the 401ks, but head in a more, let's say, hopeful direction by looking at how you can get the most out of your company match. Now, another article, The Balance, called Getting the Most from Your Employer 401k Match, that actually has some useful insights for us here, Tony. And the article first highlights the importance of what is called stretching your match and reminds us that some employers offer a 100% match while others provide a 50% match or a partial match, while some companies may not even provide any matches for you. Additionally, some plans provide a lower percentage contribution of a match on a bigger percentage of your pay. For example, your company may match 50% of the first 8% of your pay instead of, let's say, matching 100% of the first 4% of your pay. So, this strategy is often called stretching the match, and it is designed actually to provide you with an incentive to contribute more money to your account, Tony.
Well, yeah, and I like to think of those matching funds as free money that we
Yes.
get from our company. I mean, a 401k match, that's free money that you do not want to leave on the
Mhm.
table. And after we've made pre-tax contributions to our 401ks out of our paycheck, that means maybe you don't contribute enough money to trigger the company match or get the full match. You
Right?
might miss out on a match entirely or a part of it. Am I stating that correctly?
Yeah. Oh, yes, Tony. I think that's nicely spells it out. In fact, let's examine, let's say, some examples of common company matches here. Okay. So the first of which is partial match, which is up to the first 6%. Often a partial match is 50% of whatever amount you contribute. Now, in this instance, your company contributes 50 cents to your 401k for every dollar that you contribute up to that 6% of the annual gross salary. Now, essentially, that means your company is matching just 3% of your salary, but you need to contribute 6%, Tony, of your salary to receive that entire match. Now, here's an example. Let's say if you make $50,000 annually and contribute at least 6% of your paycheck to your 401k. Well, then you'll get a company match of $1,500 a year. And 6% of that $50,000 is $3,000. And your company will contribute half of that, which is $1,500. So then when you add that $1,500 to what you've already contributed, the full amount going into your 401k becomes $4,500, but just 3,000 of it comes out of your own paycheck, Tony.
Yeah, I like the sound of that. That's good
Mm-hmm.
information to know about too. What about a dollar for dollar match, though?
Ooh, well, with this type of match, your company may contribute a dollar for every dollar you contribute to your 401k until you reach a total of, let's say, 5% of your before tax salary for the year, Tony. So that means, let's say, if you make 50,000 again, for example, a year, and add 5% to your plan, you've contributed $2,500. Now, from there, your company contributes an additional $2,500, or let's say 100%. Now that brings you to a total of $5,000
Wow.
for the year. And it's an important thing to remember, or one thing to consider here, is that some companies require you to work for a certain amount of time, though, before it begins to match, Tony.
Yeah. And as a lot of our listeners out there probably know, the IRS does have annual contribution limits for
Hmm.
401ks, right?
Hmm.
What are those limits this year?
Well, this year you can contribute up to $23,000 of your pre-tax income to your 401k. And if you're 50 or older, actually you can contribute an additional $7,500 for what we call the catch-up contribution. So additionally, the combined contribution between you and your company may not be more than $69,000 or $73,500 with the catch-up contribution included, Tony.
Yeah. They want to let you have a tax break, but not that much of a
Right.
tax
They're
break.
not that friendly for
Yeah.
us.
So that's good info, though. And I appreciate how clearly you're describing this and presenting it to us. But seeking additional guidance on this and advice managing your 401ks is, again, it's so important to work with somebody like yourself directly, isn't it? A fiduciary who's going to look out for your best interests when it comes to any type of retirement savings, right?
Hmm. Oh, yes. I mean, there's all kinds of different rules for your 401k, especially, Tony, and people need to understand the things that they can do or not do with it. Okay. In fact, if we're looking at it, let's talk about dedicating your 401k, your dedication to it, the money that's in there, that's to you. You own that money. A lot of people think that, okay, I have to be there for a certain time, but 401k belong to you, even if you decide to leave your company for another opportunity. Tony, that's the big thing there. But we always take a rule of thumb for folks. If you
Sure.
are leaving a company, your 401k needs to leave with you, fire with you, quit with you, or retire with you.
Yeah, if
Never
you're not
leave.
working there, don't leave your money there in the
You got
401k. You got to transfer it over. But I'm guessing there's more to that. So, even though the money you contribute to a 401k belongs to you, even if you leave, no matter when, but there's more to vesting than that, isn't there?
There is, and that's why you want to think long and hard before you make those decisions. Now, it's true that you may want to delay your job search until you become fully vested with your current company, especially if, let's say, you're near that full vested line. But I'd also note that you shouldn't keep your current job if you're unhappy, Tony. I mean, that just doesn't make sense overall. And if you have let's say, a new career opportunity with a higher salary than your current position, well, then maybe it may be the right move for you. And again, if you have a 401k concerns, let's say about moving into a new job, it's worth a conversation with your financial service professional before you make any rash financial decisions.
Yeah, and let's reiterate that the term fully vested or vesting, what we're talking about here, means that you've reached the amount of required time at the company to leave with that employer contribution. Well, you can keep your own contribution. What you're saying is if you leave before the vesting period is up that's set by the company, you don't get to take that
Your
company
portion,
match.
correct,
Yeah.
correct.
So some people, I bet you've seen this where you have to work there. Let's say their vesting period is 4 years, right?
Yep,
So
yep.
you've worked there 3 years and 9 months, and you
Then,
decide, hey, I'm going to take another job or I'm going to quit.
yeah,
Had you just stayed a few more months, you would have gotten all that company match. And
yes,
because you didn't, you lost it. So it's good to know what the vesting period at your company is. You should ask
right,
HR, right? And you should make
definitely.
sure that you talk to a financial professional about it before moving from your job. Because, like you said, how do I transfer the 401k? Do I leave it there? Do I roll it into an IRA? Do I put it into my new company's 401k? There are a lot of decisions that need to be made. So I think that's really important. And it seems like common sense that you'd want to think long and hard before leaving your current company
Hmm.
before you're fully vested. Now, when does the year end for a 401k match? How do they do that?
Well, the IRS contributions reset annually, basically. January 1st for 401ks, and
Okay.
contributions made up until December 31st are counted towards that year's contribution limit, Tony.
Okay.
And I
Yeah.
want
And
people to understand, hold on, just quickly, is that don't think of your 401k like your IRAs that we're going to talk about here next, but it doesn't have the same type of a timeline schedule. Okay.
Okay.
People think that with an, IRA, that 401ks, they can go ahead and just move it. But there's certain rules to both that they want to make sure that they're applying to.
Sure.
Okay.
All right. Well, let's move on to the next item. What do you want to discuss next?
Well, let's push ahead with our conversation here about retirement income, but now let's change our focus a bit from the 401ks to the alternative. So, an Investopedia article titled "The Best Alternatives to a 401k" actually provides some details I'm eager to share. So, let's begin by looking at traditional IRAs and Roth IRAs. Now, if your company doesn't offer, let's say, a 401k or you're self-employed, then you can establish an IRA or individual retirement account. Now, these accounts may provide certain tax advantages depending on whether you use a traditional IRA or a Roth IRA. Now, you may also be able to save money in one of these accounts on top of your 401k. However, you should note that depending on your income and the type of the account, your contributions may not be tax deductible. But even here, the money in your account will still grow tax-free until your retirement. So for this year, the most that you can contribute to an IRA is $7,000 for people under 50 and $8,000 for those 50 and older, Tony.
Well, are there early withdrawal penalties for IRAs
Oh,
then,
great
like
question.
there are for
Yes.
401ks?
In most cases, both 401ks and IRAs have early withdrawal penalties if you take distributions before you turn 59 and a half. Well, there are some exceptions to the rule as well.
Okay. So if there's a chance that you'll need to make withdrawals then before you're 59 and a half, that's likely something you won't want to do. You'd only want to do, I should say, if you're working with somebody like yourself, a financial professional. What do you have for us regarding traditional IRAs versus Roths? I know we've touched on this before, and you're big on this, right? I mean, Roth
Big time.
IRAs are a big deal, right?
That's a great question, actually, Tony. And deciding between, let's say, a Roth IRA or a traditional IRA often comes down to whether you want to pay your taxes right now or pay them later. Now, with the traditional IRA, your contributions are immediately deducted pre-tax, and that means you'll pay income taxes once you begin withdrawals, which can still be a decade or more down the road. Conversely, though, if you elect to utilize, let's say, a Roth IRA, then your contributions are after tax funds. And that means when you begin withdrawals, they'll be tax-free. And additionally, your earnings and investment growths are also tax-free. And furthermore, with a Roth IRA, you won't have required minimum distributions, what we call RMD, when you turn 73, which isn't the case for your traditional IRAs and 401ks, Tony.
Okay. So how do we go about choosing between a traditional IRA and a Roth IRA?
Well, when making a choice between traditional IRAs and Roth IRAs, Tony, a solid place to begin is simply asking whether you may end up in a higher tax bracket when you retire. And if you and your financial service professional think future tax brackets will likely look like today's brackets. So IRAs, both traditional and Roth, have benefits and also drawbacks that may make them a good fit for some and a poor fit for others.
So what do you have for us on SEP IRAs? I've heard that term SEP. What does that mean?
Well, SEP stands basically for self-employed IRA. So if you're self-employed or own a small business, you may be able to open a simplified employee pension. That's what the SEP stands for, which operates like a traditional IRAs. But when it comes to the tax advantages and investment options, they may also be helpful because they have higher contribution limits. So contributions in an employer can make to a SEP IRA can't be greater than the lesser of 25% of the employee's compensation, or $69,000 this year, Tony.
Okay, so how does traditional investing fit into all of this?
Well, there are times when traditional investment accounts may be the ideal fit for your financial strategy. So you can establish, let's say, an account at your chosen financial institution, and then you can then contribute as much money as you prefer. After that, your profit, whether from appreciation or, let's say, dividends, will be taxed as long-term capital gains if you hold onto your investments for more than a year, Tony. So this may mean that you'll have a lower rate than you would on an ordinary income. And then while contributing to a 401k or let's say an IRA may provide important benefits like deferred taxes or tax-free growth, the annual limits may prevent you from investing enough money to actually enjoy the adequate retirement income in the future. So accordingly, supplementing a retirement account with a taxable account you've invested, let's say in a stock or bond fund, may actually offer an extra boost for your financial strategy and eventual retirement. And let's say if you're willing to handle the normal highs and lows by sticking with your strategy, in fact, a standard investment account may meet your needs, but you must put in the work and realize that you'll have to pay capital gains on that growth. Now, let me close with some important words here. In my professional opinion, Tony, if investing is something you want to include in your financial strategy, I think that's very essential to not only do so when working closely with a financial services professional, because the investing world is complex. And while it can provide rewards, it also comes with a lot of risk, Tony.
Yeah, it can. And this has been an excellent show today, Albert. But we're out of time. Before we go, let our listeners out there know how they can get a hold of you.
Yeah, folks, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen, or call the office at 586-752-7008. Discuss how we can answer your questions, address your concerns about your 401ks, your IRAs. Remember, it's our goal to help you prepare for the retirement you've worked so hard for so you can own your retirement.
All right, and that does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care, everyone.
Yep. Thanks, Albert.
Thank you, Tony.